Are we there yet? That's the theme of this QEO this time. We always like to have a theme, and that does reflect, as you can see by the bored, exasperated expression on this little girl's face sitting in the back of the car. Anyone who's got kids will have known this situation. You're on a long drive, you're just about where you're going to get to, but people are well over it at that stage. And the theme of this story is, well, just how much further do we have to go before we actually get to some sort of like sustainable recovery? Obviously, the Reserve Bank gave us a bit of a view on this yesterday. Big surprise to markets. They basically threw in the towel and said that it's going to be a while before we get there. So the kids were screaming in the back. So they threw a couple of pizzas, a bottle of Coke and a couple of bags of lollies back there to shut them out. If I go back to the parental analogy, we've all been in that scenario and we all know what happens. And I mention that because I think we have to have a look at some of our macro forecasts in light of what happened yesterday, because we're looking like we're going to get lower interest rates than what I thought was likely to occur before yesterday, and there will be implications of that. So, are we there yet? So the main areas I'm going to cover here is a bit on the global environment, and of course the global environment has been all-consuming in the last few months or so. Then I'll talk a little bit about what's been going on in the economy, the medium-term outlook. Fiscal policy, obviously something that's pretty interesting to Wellingtonians in particular, and then ultimately what it means for interest rates, exchange rates, and Imre in particular is going to give us a pretty good sense about what he thinks will happen next. So with respect to the global economy, this has really been centred around the policies of Donald Trump's administration. Donald Trump in large part is really the gift that keeps on giving. If you're somebody who works in markets or economics right now, there's obviously been a wild ride in the last few months as a whole lot of policies have been introduced that have really upended the rules of the global trading system that have been established probably for about 40 or 50 years now, really. So we're all having to kind of like adjust to that. We're also having to adjust to Donald Trump and the US administration changing what they think they want on an intraday basis in some cases. So that's driven quite a lot of uncertainty out there in the global economy, in the domestic economy as well. And the question is, well, how much ultimate impact is that going to have on this, what was beginning to be a recovery in the economy that we had started to see at the end of last year, and particularly in the first part of this year. So my first question of you for the Slido is that if you think about the level of uncertainty that's out there at the moment in the world and how that's going to impact on New Zealand, what do you think it's going to do? And I'd like you to think about it from the perspective of your own situation or business as opposed to kind of like everybody else's. Do you reckon that uncertainty and the impact of that is going to be, very large, and it's increased quite a lot in the last few months? Or do you think it's actually decreased quite a bit, or something in the middle? Let me know kind of like roughly how you're feeling about that. Is this a consequential thing for the way that you're thinking about behaving or how your business is going to operate? So we've got about 40 odd votes there. It looks like it's starting to stabilise at around that sort of level. So, increased a bit seems to be the call that I see there around the crowd. I mean, that's probably not unreasonable in terms of the quite variable news flow that we've had in the last while. If I go through to look at what's actually been going on in this space, there are not many charts in my chart deck that go back to 1791. In fact, when I tried to do it in Excel, I had to play with it quite a bit because it didn't understand 1791. But you can kind of see that what is going on with US tariff levels is something that we haven't seen since before the 1930s. And before then, obviously, you're going back hundreds of years. So it's pretty consequential times here right now in terms of sort of like that, kind of basically the rules of trading with the United States. But on the other side, you can kind of see what's happened in the last sort of few months or so. And what I want to emphasise there is that it has been a wild ride. You can see that the effective tariff level based off the US administration's announcements has been extremely variable. We had that crazy night, I think, back in April where Donald Trump and Chairman Xi were having a bit of a bidding war in terms of how high they reckoned they could put tariffs on each other. And, when we were in the middle of that period, things looked really dark out there for the global economy, because the thing that most economists would tell you about this is that things are a lot worse when you get a lot of retaliation and where the pain associated with the increased tariffs gets spread more broadly around the rest of the world. Now, what we have thankfully seen since that crazy night is everybody stepped back from the brink. And so those really high tariff levels between the US and China have been scaled back really significantly. It's the situation that is not entirely resolved, but what has tended to happen in the last few months is that deals have been done and the rules of the game are becoming much better established and understood now. We are looking at a level of tariffs going into the United States that are significantly higher than they have been for the last 20 years. Something around that 18% level, I think, is the estimate that I see from people who claim to know. But in terms of uncertainty, my read of this is that actually because we understand more about how this is going to play out, that the risks of those really big retaliatory moves going on between important countries has been substantially reduced, as both parties have tended to sit back and say, well, it's actually better to deal than fight here. And the reason that all of these deals have been done between the US and various large trading partners reflects that as well. Everybody recognises that there's no point just going into a bidding war with Donald Trump on tariffs. You just need to kind of basically come to some sort of deal and then adjust accordingly. That's actually probably for the greater good, at least relative to the fears that were sitting there perhaps back in April. How this has been impacting on trading partner growth is that in aggregate we continue to think that trading partner growth will be some way south of where it was, certainly for the sort of 10 years or so before COVID. The main impact of the trade war on our forecasts has really been felt predominantly in the United States. And the point there that we're kind of continuing to make here is that tariffs primarily are an act of self-harm for the United States. It's going to be the US consumers that are going to primarily bear most of the brunt of this, and it's going to be something that impacts in particular on the level of growth in that US economy. So if we look at sort of like some of the biggest adjustments in forecasts that around the world, we see much bigger adjustments in our US forecasts, basically going from sort of like a 3-ish% growth rate to something more like about 1.5%, and much smaller adjustments elsewhere. And in particular with respect to China, we've tended to adopt a relatively optimistic view that the authorities will continue to deliver that 5% type growth target rate. And interestingly enough, in the world of economists out there, they've tended to come to that position in the last 6 weeks or so. So I'm raising this in that, like, even though there is all this noise about the trade environment and tariffs that continues to consume headlines, in terms of the actual macro impact on us, on the world, it's actually improved relative to where it was a couple of months ago. And you can see that reflected in consensus forecast of growth for 2025, 2026, which have revised up from that kind of low point in April, and are certainly lower than they were before all of this kicked off, before March. But when you're looking at an adjustment down in global growth prospects of 0.1 or 0.2%, I mean, this is like margin of error stuff really, as opposed to something that should radically rock your world. In terms of how the domestic economy is going right now, well, we've really got an unbalanced set of growth around the country, around the regions, around sectors. And I've kind of like categorised this rough table to sort of give you an idea of the good, bad and the ugly, basically, with respect to how the economy's going. There are some real laggards in the economy right now, and the labour market is front and centre, probably some of the biggest part of the economy that is still continuing to do it quite tough. Jobs growth is not yet positive on a sustainable basis. The unemployment rate is continuing to rise, not quickly, but it is continuing to rise. And right now, I don't think we have a prospect that we could expect a lower unemployment rate, certainly in the next few months or so. Reserve Bank basically came to that conclusion as well yesterday. And that's being reflected in the performance of a lot of sectors that people would traditionally think of as like interest rate sensitive as well. So things like hospitality, retail, continue to be quite flat. And there is this kind of like sense out there, at least amongst some, I heard a bit of this from the Reserve Bank yesterday, that, oh, maybe interest rates aren't really doing their job yet. And I guess that's that kind of question of the lags and how long do you reasonably need to wait for things to bounce back. The other issue is that the construction sector is obviously one of the weakest parts of the economy as well. You've seen considerable losses of employment in the construction sector, plenty of stories of people that working in construction who have moved to Australia, for example, where there are much better opportunities. We've got a nice paper coming out next week looking at a comparison of the Kiwi and Aussie economic situation that highlights that quite nicely. So those are the weak bits. And actually, if I had to put another leg on in here, I would say government-related businesses as well would be the case. And obviously, that's pretty relevant for the Wellington situation. But there are some positives out there as well. Commodity prices are at very high levels, as are our terms of trade. And optimism out there, particularly in the regions, is very positive right now. Farming sector optimism seems to be quite high. I'm always quite shocked sort of listening. I mean, I come from an agricultural sector background, and you know, if I remember farmers ever saying, "Oh, things are kind of okay," that basically means it's a pretty bloody good year, right? Now they're actually saying, "Oh, things are actually really good," and I'm sitting there going, "I don't know where to put that on the scale of optimism." But they are getting good coin out there at the moment, and they're probably expecting to continue to have it for a while as well. It's not really being felt in the urban areas, but it's absolutely being felt out there in the broader economy, and it's having beneficial impacts for the rebalancing of the economy that's going on. There are parts of the economy that have actually responded to the 250 basis points of easing that has already occurred. And we see that particularly in house sales, which have actually rebounded reasonably strongly, as you might expect, and also in business optimism, particularly where businesses are particularly optimistic about the future, and it'll be very interesting to see how they behave over the next few months. And the other thing that I think is a bit of a positive here is that the infrastructure pipeline is actually quite full now, because I mean you've all noticed your rates bill going up, right? But that money is actually, or at least a decent amount of it, is actually going to be going into some infrastructure spend in the regions. We're going to increasingly see that as we go through the while. And in the middle, we've got some mixed sectors. Manufacturing, bit up, bit down, was a bit weak a couple of months ago. If you look at the PMIs, they actually bounced back quite nicely last month. House prices, what are they doing? They're pretty flat, maybe probably sideways is the best assessment. I actually think that's probably quite a good thing, to be honest with you, but different people, John Key, for example, apparently disagrees with that. Tourism sector is mixed as well. Yeah, it's on the improve, but it's still a wee way below 2019 levels. And what that means is that for the economy overall, firstly, growth is very unbalanced around the economy. It's not the case that growth is occurring everywhere, and it's also going to be a pretty bumpy ride for GDP as we go through the next year. Now, we think that in the second quarter, after having a couple of good quarters of growth that we saw, where 0.8% in the first quarter was excellent, it'll be zero in our forecasts in the second quarter. Some of that is statistical noise because Stats NZ seems to have left us with seasonality in a seasonally adjusted series. And when you try to work out which sector of the economy that's coming from, it doesn't come from a particular part of the economy or a particular region. It's in the unallocated item. One of the issues we have with trying to use macro data here at the moment to gauge where the economy is. Reserve Bank took a bit more negative view on that. They put minus 0.3 in for second quarter GDP in their forecast yesterday. Could happen. Seems quite pessimistic, but it could happen. But then we do expect to see some of that get paid back at the end of the year, partially as a reflection of that seasonality, but also crucially because things like interest rates and commodity prices are ultimately supportive for a recovery of growth in the economy overall. So it's a bumpy, but an underlying improving trend is what we expect here. And, you know, if I redo our forecast in light of the interest rates changes that happened yesterday, I mean, I suspect some of those red bars, particularly once you get through into 2026 or so, will probably go up a bit when we think about how that should go through. And it's coming through because, you know, these interest rate cuts, and this one was based off, you know, before the MPS yesterday, so there's going to be a bit more in terms of falling mortgage rates, is actually generating quite substantial benefits, both for new borrowers in the sense that the hurdle rate for them to getting into something is much better now than it would have been. You're probably looking at a mortgage rate closer to 4.5% than 5% now, ultimately, I would say. And for people that have already got a mortgage, as they roll off onto those new mortgages, and there's half the book will reprice in the next 6 months, that's generating, you know, could be $500-600 a month, basically, in the back pocket, which is going to be spent somewhere. As I mentioned, in the agricultural sector, we continue to expect that they're going to retain these really strong prices out there. And, you know, what has happened here with this tariff shock is that luckily we've been hit at quite a good time, because even though there's been this shock to global demand and some pressure probably on pricing as well that would have otherwise occurred, because the supply is so constrained in the commodities that we export out there, they kind of have to buy it and they kind of have to pay for it. You know, the US demand for burgers, for example, I understand is insatiable. So right now, you know, if anybody knows of a lamb or a cattle beast sitting on a paddock somewhere that you don't know what to do with, let me know, because I know somebody who will buy that because they can't get enough of the stuff. And that's why it's the Americans that are going to end up paying for a lot of those tariffs, because they need the product. Same with the Australians. You know, if I talk to the Australian team, they see the same thing. There's a bit of diversion of trade going on as well. Some countries out there like China that used to import from the States don't want to now because they don't like what's been going on with the trade negotiations. So things like beef and dairy markets, they come to New Zealand to look for alternative supply. It does mean that we can probably reasonably expect this cycle in commodity prices to persist for quite a bit longer yet. It's not like we're sitting on an oil well or anything like that. I mean, there will be a cycle in commodities that comes eventually, but probably not just yet. In terms of looking around the country, we can clearly see that the benefits of some of this are not really being evenly shared around the country. So if you look at the weakest spending area, it continues to be Wellington. And also some of the more urban areas, like Auckland is sort of at the bottom end of the list. But, you know, the ones that are really performing here down in the South Island, some of the kind of like more rural orientated parts of the country where consumer spending is frankly rising quite strongly. And that is a narrative I think that probably I need to emphasise here, is that we get a lot of narrative being driven by people living in places like Auckland and Wellington saying, oh, nothing's happening. Stuff is happening, but it's just not happening in your neighbourhood. Business sentiment kind of reflects a lot of what is going on here with interest rates, I think, and we've had this quite remarkable gap open up between where businesses say things have gone in the last few months and where they expect them to go in the future. Historically, if we forecast GDP, we would actually probably use the black line, what happened in the last few months, to kind of like illustrate, to work out what GDP has done. It's actually turned out that the red line has been more accurate in the last 6 months or so. So, you know, we have to basically see, well, you know, what's going to happen here? Is the black line going to converge to the red line, or is the red line going to converge to the black line? My sense on this is that, especially given with this quite expansionary stance that the Reserve Bank is now taking, and you should probably expect the black line to converge to the red line. And indeed, that's the objective of the bank here. House prices. Flat is probably the only way that you can really talk about it. Not flat in Wellington, falling in Wellington, unfortunately. But look at the sales part of it. You know, one of the things that's frustrated my house price forecast this year, and they haven't been that flash, is that I expected that as sales improved, as interest rates fell, that house prices would as well. But what has tended to happen here unusually is that the supply of housing has responded at the same time as demand has increased. Partially that's a reflection of a lot of people having not put their house on the market for the last few years for a combination of COVID and the fact that that house prices have been falling in the last few years. Also, it's a reflection of the fact that even though the construction sector is at a cyclical low point, it's actually troughing at a much higher level of activity than it ever has done before. So there's actually a decent supply of new properties going on the market. There's actually been some changes in zoning and planning laws that have probably helped contribute to that. Quite a lot of smaller units like townhouses and apartments being built now because those are more affordable particularly for first home buyers. But the Reserve Bank is right in saying that, well, because these house prices are doing 0 as opposed to 5-10% per annum, then there is less of a boost there coming from particularly urban consumers from feeling wealthier because house prices are going up. I actually think that's quite a good thing. So I'd quite like my kids one day to be able to buy a house. All right, migration and labour market. I mean, that's obviously been the weak point there. What we've tended to see is migrants' net migration to Australia go up to cyclical highs, and that really does reflect the differences in the unemployment rates between New Zealand and Australia. And frankly, we would expect that to continue at these sort of levels for a while yet before that unemployment rate starts to fall, probably mainly next year. And I talked a little bit about tourism before. It's one of the kind of mixed, possibly a little bit brighter areas. We're still kind of 90-95% of 2019 levels. We're getting plenty of Australians and Americans in, but we're actually not getting as many Chinese as we used to. Perhaps that reflects the underlying Chinese situation in the economy. And we're actually getting quite a lot more Kiwis coming back as well for holidays. And I guess that's to some extent the flip side of the outward migration we've seen in recent years of New Zealanders. Do have to come home to see mum sometimes. So the medium-term outlook, well, we would say that it's still fairly bright here. Lower interest rates, stronger terms of trade, these are the foundations, basically, of a cyclical recovery. Probably beginning second half, well, very late this year, I suppose, and particularly through next year, and then continuing on. It's not an exceptionally strong forecast. We suspect that potential growth in the economy probably is really only about 2-2.5%, so we shouldn't really expect it to be a rock star economy unless something changes. But we do think there's a reasonable basis for expecting that recovery as we go through the next couple of years. The fly in the ointment here a bit is the inflation rate, which is now looking like it's going to go over 3% for the rest of this year. Reserve Bank reluctantly agreed with that assessment when they gave us their forecast yesterday. However, what they have decided to do is ignore that and focus on the forecast of inflation falling back towards 2% next year. I'd say towards, actually. It's actually kind of going back to about 2.2%. I reckon that's pretty optimistic myself. It's almost as if actually the Reserve Bank here is targeting 2.5%, not 2%. And in fact, if I look at the 20-year average of inflation in New Zealand, it's averaged about 2.6, 2.7%. If I look at the average of the inflation rate over the whole inflation target period, it's been close to 2.3. Could be something to watch here, actually. We've got a new governor coming in the next couple of months. Could be an opportunity to have a look at that inflation target. But what I am telling you here, though, is that the idea that inflation might fall substantially below 2 looks to be a little bit of a more remote prospect right now. Business investment, we're expecting to kind of pick up. We've actually taken a view on the investment boost policy is that what Treasury sort of suggested would happen, which is about 0.5% increase in growth over the longer term is probably the best guess of any. We don't think it'll be very evenly shared, though. We think that, particularly the agricultural and primary sectors would be the biggest beneficiary of that policy because they've got the best cash flow right now. Perhaps a bit of stuff in property now. The interest rates have gone down. I mentioned the infrastructure story. This is actually a brighter sort of picture, I think. And, I'll go forward to the next slide. Right, we've all noticed that your rates bill's gone up. You've all noticed that the rates bill's gone up relative to your wages as well, I suspect, for most of you. Well, that money is going somewhere, and that's where it's going. It's going to go into water, it's going to go into a whole range of other infrastructure spending. And, you can certainly see it particularly reflected in how much it's costing to do infrastructure. So the nominal spending amount has rocketed compared to the real spending amount. But the underlying trend there that we expect in infrastructure investment is pretty solid. Basically in line with that trend we saw sort of through the second half of the 2010s, basically. And the labour market, it's the last shoe to drop. Are we there yet? Well, if you can only gauge it off the labour market if you're prepared to wait until you can basically see grandma's house when you're actually kind of like getting there at the end of the drive. It's the last thing to respond. The good news on the labour market is at least the unemployment rate hasn't risen very quickly in the last 6 months or so. It's looking like it's probably going to top out pretty close to where we are, 5.2, 5.3%, but it probably isn't going to fall substantially until the end of this year or perhaps particularly next year. We expect positive employment growth in Q4 and obviously stronger employment growth after that to really drive that improvement. Fiscal policy. This is a better news story actually. Treasury had some very pessimistic forecasts when they did the budget a couple of months ago. That's because they finalised them right in the teeth of Donald Trump's first announcements about tariffs. And they went with a very, very negative view on things like export prices, the terms of trade and global growth, all of which are looking well underwater now in terms of like those numbers being a lot better. And what that means that if we look at Treasury's forecasts, which was for a surplus achieved in 2028-29, we think that they'll probably have more revenue than that, probably another 10 or 15 billion more revenue over the next few years. And then the question is, well, what happens to that revenue? Our sense is that they probably won't save it. They'll probably spend it on something, and that is the good news, I think. Now, what are they going to spend it on? I think there will be some core spending priorities that need to be met because the underlying assumptions in Budget 25 implied a remarkable level of fiscal restraint for the next few years. And by remarkable, I mean probably unrealistic. But there is also probably a bit of money to chuck around there if they wanted to have a maybe a small business SME tax cut or some other kind of program. We do have to remember that it's election year next year, so that's a good time generally to spend money. So it'll be very interesting to see how good the high FU forecasts look and ultimately what the government's stance is about that. The other thing, current account surplus starting to gradually improve but remaining relatively wide, still at 4.5% of GDP if we get to the back end of the forecast. So we are still very much in this picture of twin deficits. Persistent fiscal deficit, persistent current account deficit, sort of things that don't usually make foreign investors and credit ratings agencies that happy. And it will be interesting to see how the ratings agencies look at us next year, particularly if it does turn out that any extra revenue ends up getting spent as opposed to saved, because I think the ratings agencies would prefer that money to be saved and for surplus to be met a lot more quickly, to be reached a lot more quickly. So where does that leave us with interest rates? That's my second question of you today. What do you guys reckon? Where do you think the OCR is going to bottom out? A few options there, quite a broad range. Seems appropriate given the circumstances. Let us know what you think. 28 people, 35, we're getting there. I think we got to somewhere in the 40s last time, if I remember correctly. So people like the Reserve Bank's 2.5%. Actually seems like a pretty good bet to me. I don't really necessarily agree that that's what they should be doing, but that is what I think they said they were going to do in very reasonably short order. So there's not very many people looking at the very low interest rates. Yeah, that's interesting. Not too far different to our forecasts. We do have this kind of juxtaposition where inflation's actually quite high, and I think inflation expectations are too high as well. So it'll be interesting to see how that pans out as the Reserve Bank navigates the next year. But for now, I think it is very reasonable to assume that when they tell us that they're going to have rates pretty close to 2.5 by the end of the year, then that's what will happen. I think the main thing that would derail that is if there was a relatively quick bounce back in the economy coming from this announcement, and maybe that could happen. But one thing that I would have probably advised you up until Wednesday is that I would have thought the inflation outlook would be something that would cool their ardour for significant rate cuts. But they're actually saying they're prepared to take that risk. So that's what it is. What I suspect that means is the inflation outlook for next year will still remain quite sticky in the sort of mid-twos as opposed to kind of like anywhere near 2%. And that will probably lay the basis for, you can see those rate hikes that we've got in the forecast starting after the election next year. By that stage, I suspect we'll be in a situation where inflation is still above 2%. Economy will have actually been growing fairly decently for a few quarters by then, and there'll be increasing nervousness about where the inflation rate is really eventually going to go. I will say we'll be looking a bit more closely at the timing of those rate hikes as we go through the next couple of months. Logically, they may need to be brought forward, although there is the complication next year that there is an election. And it's quite hard for the Reserve Bank to be embarking on a new strategy if there's an election campaign going on. So with that, I'll hand over to my colleague Imre, who will tell you what he thinks the markets will do.
Thank you, Kelly. So yesterday was quite an exciting day, and I had to go back and redo my pack, and here it is. A quick refresh. Thoughts on the currency for the months ahead. Lower against the US and against the Aussie, and for interest rates, mostly short end, but also long maturity, probably a bit lower still. And yield curve shape, for those who care about that stuff, probably a bit more steepness to come. But as we get to around the end of the year, I think that's going to be a major turning point and a major, probably a major trading opportunity for a lot of people, but we're not there just yet. Okay, so diving into each of those in turn. So last time around, about 3 months ago, for Kiwi US, we thought it would go up further. I had 62 on it, got to 61.20, wasn't a bad forecast. That was predicated on the idea that the world was just selling the US dollar. So it was a US dollar story. Everybody hated the US dollar for all the bad stuff that was happening there. And we thought that would persist for at least a few more months. And that's true. Although that story, we sense, has really waned, especially in the last month or so. It's almost becoming a non-story now. And now we look ahead, and I think, which I'll explain in the next few slides, there's potential for the US dollar to do a bit of a rebound, combined with this latest move from the Reserve Bank, which is more dovish than what the market expected. I think those two things together will cause the Kiwi to go down further. Where does it go to? This is where you've got to put your technical analysis hat on. And actually, for those who like to look at these things, there's a really nice head and shoulders set up here. It's breaking the neckline, and the textbook will tell you it's going to 56, according to best technical theory. That might be a bit of a stretch, so I've got to go down to about 57.5 first up, which is a sort of that was a resistance point quite a few months ago. That would be a fairly logical point for the Kiwi to bottom out at. So yeah, looking at things that drive it, most of the time, as we know, it's the US dollar. So what's the US dollar done? Just as a recap, ever since the inauguration in the US, it has just gone on a big slide, and that went on an accelerated slide after those Liberation Day tariffs, and the world just wondered what the hell was going on, and that's when they really started to exit the US dollar. As you can see, that's kind of ground to a halt, and in fact we've had a very gentle rebound. So I think there is potential for that to kick on a bit further. The market is still very, very short the US dollars in a speculative sense. So there's, for at least rebalancing reasons, if not the idea that maybe the US dollar isn't quite as dented as we thought it would be, we could get a bit more of a rebound in that broad US dollar. Also interesting as we look at the correlations of things that drive the Kiwi US. Yes, almost all the time it's the US dollar is the dominant thing, but that's actually been in a very gradual strengthening trend in terms of a relationship, in terms of its influence on the Kiwi US. So more than ever, you could say, the US dollar is important. And as for the other things, like risk sentiment and interest rate spreads and even commodities, those things have really waned, particularly since that Trump administration unleashed all of their wild policies. So really, it's all about the US dollar right now and very little about other things when you're thinking about Kiwi US. And positioning worth a look because, about 6 months ago, the world was quite short the US dollar. They expected it to fall, and they're basically bailed out of those positions, and the speculators are now what I'd call close to neutral. What that means, it's now positioning is not a headwind as it was a few months ago to a decline in the Kiwi US. So positioning is fairly well balanced now. On to Kiwi Aussie. Last time around, we thought we'd get maybe a wee bit more of an uptick, but we were turning the corner in Kiwi Aussie, and we thought we'd get a fairly decent slide, and that indeed did occur. And looking ahead for the next few months, I think that's got quite a lot more potential still. The reasoning behind that is two-pronged. Firstly, interest rate differentials really matter a lot for Kiwi Aussie, almost all of the time. And what are they doing? Well, we had a big downtrend over the last year and a bit, and then a bit of a correction, and now that downtrend, I think, is resuming. And so I'd expect to see interest rate spreads falling a bit further. Thinking about what the two central banks are doing, the RBA is also in an easing cycle, but it's very measured and very cautious, and they're not going to be doing a lot. The market's actually priced in another 3 cuts, but there's a risk that you might get much less than that. Whereas on the Kiwi side, we had that news yesterday that surprised pretty much the whole market. It was a lot more dovish than was priced in than anybody expected, and also the market has reacted to that already, but I don't think that they have reacted quite enough, and I'll show you a bit later on when I put a rate slide up. So I think there's a potential for markets to price it a bit more for the Kiwi side, maybe yank out a bit on the Aussie side, and you'll see that yield spread falling and therefore putting downward pressure still on Kiwi Aussie. The second factor there is China. China has been at pains to really invigorate its domestic economy, get the consumer to become more active than it has been. And it has announced a string of things, things like infrastructure, subsidising loan interest rates, all that kind of stuff, trying to prop up the property market. There's a lot more in the pipeline to come. And they can still play around with the policy rate as well. They've got a lot more room on the policy rate front. So we're quite bullish on China. And as we know, good news in China translates into a stronger Aussie rather than a stronger Kiwi. So for China reasons, yield spread reasons, we think Kiwi Aussie has further downside potential. And as a side note, for those who are interested in, who have Aussie exposures and they get involved in hedging between Kiwi and Aussie, options are as cheap as they have ever been in vol terms. Vol is at a record low. Yeah, staggering stuff. So what it means is that regardless of whether you're a buyer or seller of the cross, the volatility, which is a major component of pricing in your option premium, is now as small as it's ever been. So if you're thinking about that, it's worth at least talking to your Westpac rep and saying, how do you do these things? What are they priced at? Is it worth having a look? At least, have a look into it because, they are very, very cheap. You got to ask, well, why are they so cheap? Why is vol at a record low? The best guess that I can come up with is it's just been very range bound now for almost a decade. So the grey line up at the top, that's Kiwi Aussie. So that's in Kiwi Aussie terms. You can see it has been pretty much a sideways trend within a fairly big band. So when you get that sort of stability in markets, vol does tend to drop away. But incredibly cheap. And finally on interest rates. So last time around, we thought we had, at least in market pricing terms, reached a bottom in this interest rate cycle. We got that wrong. The market, it did actually start to turn up and then it went for another spell downwards. And why was that? Well, that was a twofold reason. Partly the US rates, which are now pricing in a lot more rate cuts. And there's a spillover to the rest of the world's interest rate markets, including ours. So that was part of it. The second part was some of the data here was soggier, and speculators in particular, they like to receive or bet on Kiwi rates falling rather than the other way around. That tends to be a bit of a skew in their bias. And so when they see any sort of soggy data, they go, oh, here's another reason to go and put a trade on and bet on rates falling. So there was that effect as well. The two combined did actually push rates lower. And then, of course, yesterday we got that big surprise which broke it out of that range. So we thought at best 3% in the 2-year would hold. That's broken. And now I'm looking at about 280 as a rough guess for where the 2-year swap rate could bottom in this cycle. Why do I think it could go a bit further? Just looking at where market pricing is as of right now, and this was refreshed this morning about an hour ago. So that's the black line. It's bang on where the Reserve Bank put its new OCR forecast yesterday. The Reserve Bank had it at about a 2.55 low, and markets are about there, but a bit further out in time. Whereas you've heard Kelly say that we should probably get 25-point cut in October, another one in November, and that's the cycle done. So in other words, if that happens, we'll see something more like the red line playing out. So you can see the black line really has to sort of shunt down and hug that red line, which means there is scope for a 2-year rate, which is a compounded sequence of all of those things, to actually fall a bit further, if it fully prices in what we think is going to happen. So in short, yeah, we don't think it is fully priced, but it's mostly priced. That's why I think those short rates could fall a bit further. And when that happens, of course, the yield curve shape should steepen a little bit more. Yield curves are driven more by short-end things than long-end things. So when you get those short-end rates falling, you'll get a steeper curve. That'll matter for some people for hedging thoughts. But I think as we get to the end of the year, if it looks like the interest rate cycle has indeed bottomed, we're going to see a real reversal in that yield curve shape, and people are going to be jumping on the short end, pushing those rates higher, and that's going to flatten things out. So yeah, for hedging thoughts, I think it's worth taking on board. Okay, that's it from me.